to complement his bachelor's degree in business and finance and his MBA. Earlier in his career, he managed market operations for an energy trading company and financial operations for an international shipping company. Mark is also a popular speaker for financial organizations, including the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and Society of Actuaries. And he's contributed to insurance resources publications, including Businessweek, Bloomberg.com, Forbes, NAPFA Advisor, AMA Physician's Guide to Financial Planning, Jane Bryant Quinn's book, Making the Most of Your Money Now. So without further ado, I give you Mark.
Hi, everybody. This is going to be the Mark and Keith show today. So hopefully everybody will have a little bit of fun, and we might have some jokes in here that unfortunately I've learned over the last 35 or so years. So you may have probably heard them before, but I can't help it. It's part of my upbringing. The oops factor, insurance challenges your clients may face. Every day we sort of get questions about what does this mean, or what does this mean to my clients? And so we're going to talk over some of these that come up relatively frequently and maybe dispel some myths about how bad they really are. All right, and there we go. As I was putting all this together, as you all probably know, as you're doing plans over and over, you have to find something to make them a little new, a little interesting. So in this one of the topics I started off, I thought I have a great song that would go along with this. So I decided to theme these to a bunch of different songs. So learning to fly, what are we going to learn today? By a show of hands, I can't see you, of course, but some of you probably immediately thought Tom Petty. Some of you probably immediately thought Pink Floyd. Same title, but probably a different generation. So what are we going to talk about today? First, the unholy trinity. It really sounds scary, but it may not be as scary as you think. Survivorship policies where we have one deceased or only one survivor, and you may think, oh, we're stuck in this maybe not all that great policy. Maybe not. I'm going to talk about sex, mechs, and train wrecks. How do some of these things relate to your clients, and what do they mean? Like I said, what do they mean to your clients, and how can we fix them? And in some cases, can they be fixed, or do we even need to fix them? So my first song, Kenny Rogers, 3 Times a Lady. I love Kenny Rogers. The Unholy Trinity. And this is something that pops up every couple months, and it's really scary, and I think people get really worried about it. And we're going to talk about what it actually means, because, boy, the unholy trinity sure sounds scary to me. The issue is when you have three people or 3 parties to a life insurance policy, you have an owner, an insured, and a beneficiary. And the problem, or what causes the unholy trinity, is when these 3 entities or people or parties are all different. As Keith said, that's an oops. Oh boy. Hope you all are ready for this. It's going to be a long 55 minutes. So what's the problem? If the insured dies in this scenario, and owner, insured, and beneficiary are all separate entities, the policy proceeds are considered by the IRS to be a gift from the owner to the beneficiary. I'm going to talk about that again, but that's sort of the problem. How did we get to a point where this is coming up often? Pre the unlimited marital deduction that the IRS allows, at the death of one spouse, the other spouse gets to inherit all of his or her deceased spouse's assets without paying any estate taxes. For those of you even younger than me, there was a time when that didn't exist. And so spouses owned each other's policies. That in and of itself doesn't create an unholy trinity, but in a scenario where a husband owns a wife's policy and names their children as the beneficiary, then we've created this. And so that was much more common a number of years ago for estate tax planning, getting the death benefit out of one's that spouse's estate when he or she dies. Sometimes when a policy is transferred to a trust, it may be set up so that an original policy was owned by Mark on my wife, Leah, to my kids as the beneficiaries. That's a problem, of course, but it still is convoluted if I transfer the ownership to a trust. Again, I have a trust owner, somebody else is the insured, and kids is the beneficiary. In that scenario, we've created an unholy trinity because really the trust should also be the beneficiary. By simply changing the owner to the trust and the beneficiary of the trust, we have an insured. We can't change the insured, and we've fixed it. The way we used to do it, as I said, pre-unlimited marital deduction, that's what was often done with policies. And I think it was done so often and so many times, probably people weren't even sure why they did it. It's just that's what they did. A child policy. Client may have had a policy on, parent took out a policy on a 2-year-old. That 2-year-old is now 50. We've seen it with, $500 life insurance policies that they were paying $2 a year and have grown now to $5,000. Maybe somebody changed an owner but didn't necessarily change a beneficiary. So you may have separate owners, insureds, and beneficiaries on that policy. So how do we correct it? Well, you change to have not 3 separate entities on this policy, just 2. And we can't change the insured. That's one we can't change. So an owner, same as the insured with the beneficiary. Owner and beneficiary being the same. In the case of a trust, trust owns a policy on me, and the trust is the beneficiary. We don't have this unholy trinity issue anymore. The most common correction is that husband and wife owned each other's policies. Now we just simply transfer ownership so that each spouse owns his or her own policy. Again, because there's no gifting between spouses or anything like that, there's no tax consequence of any kind created. What does it mean to your clients? Well, remember, we're not saying that the income, that the death benefit is taxable as income or anything like that. It's considered a gift. If your clients don't have a $5 million or joint $10 million estate tax, and I know there are some states that have much lower estate taxes and things like that, it's not really an issue. Okay, so your client gifts a $500,000 term policy to their kids, and their estate's worth $1 million. Okay, it's a thing, it's an actual event, but because we didn't go over any estate tax limits or anything like that, the result or any consequences are little to nothing. So for many people, it's not actually a concern in practicality. If they do have estates over this number, the 510, definitely want to investigate further and maybe move it into a trust, have spouses own each other's policies, things like that. Where we talk about the X, one issue of why we always recommend that spouses own their own policies is divorce. Nobody assumes that they're going to get divorced, but it does happen. And so we always recommend that clients own their own policies, because in the event of a divorce, then I own my own policy and I can change the beneficiary to whoever I want. If my wife, who is now my ex-wife, owns a policy on my life, I have no control over the policy that will pay out at my death, similar for her. So I can change the beneficiary on the policy I own on her, but that's not really what I want. I want life insurance that will pass on to somebody at my death. So, that's a concern when we look at the idea of having husband and wife own each other's policies. In the event of divorce, they aren't going to have as much control as they would like. And I'd like to pass it on to Keith, and he's going to talk on our next topic.
Thank you, Mark. Let me go here. As you can see, Mark's the one that gave all these titles, song titles, and there's probably only about 10% of you who've actually ever heard this song or saw the movie, 3 Coins in a Fountain, which one will it not? But Okay, that's the entertainment for the day. The Holy Trinity in a business sense. This one gets a little more messy. And because I do a lot of the business policy reviews or whatever, this happens quite often actually. Why? Well, the business is the owner of the policy. Everybody wants to use corporate dollars to pay the premiums. Usually, a lot of our businesses are small, personally owned. The boss is going to be the insured. So the person who controls the business buys insurance on himself or herself, but has the company be the owner so they can pay the premiums, but then makes the beneficiary either a spouse or a child or another owner. Why do I see this so much? Well, one is because somebody says, I want to use my corporate dollars for my personal use. That's one reason. Number two is there's not a follow-through. This can be done, and I'll jump ahead of myself, but this is basically designed as a split dollar. But no one ever implements the split dollar agreement, and so they put the insurance in force, and then the agent's long gone, and he sold his policy and didn't really care. So the idea that the business is paying the premiums on an employee, on the owner usually, but then somebody else is a beneficiary can be done, but it can't be done without taxes. But if this happens, the other reason sometimes I see this is where they set up a buy-sell, they think they're going to do it that way, and they never set up the buy-sell agreement properly, or so it ends up the policy is sold, and then everybody sort of forgets to do the details. What's the problem? Well, in this situation, the death proceeds that are paid to the beneficiary are subject to income tax, not gift tax. And if it's $500,000, somebody doesn't want to have a surprise that they got $500,000 income tax rather than either a gift or income tax free. So death proceeds are income tax free unless you violated the Holy Trinity. So this one we really need to look out for. So if a business is owning the insurance, which we see a lot of corporate-owned businesses that own the insurance, then you want to make sure that the business is also the beneficiary, because it can't be the insured. How to correct it? Well, you can restructure the ownership or beneficiary. Like I say, many times you just turn it right back, and if the business is the owner, then they need to be the beneficiary. There's no other option there. In that situation, the problem usually is that if the owner dies, the death benefits are in the business where you don't want it. We've had a couple of those actually fairly recently, a death claim where the business owned it, the business was beneficiary, really wanted it for the wife, but she had to get it out of the business as either a dividend or as salary. So, that's not necessarily the right way. The other one is to change the owner to the spouse or to your children or whatever, and then you can bonus the premiums. The person who is the owner does not necessarily have to be the payor, and sometimes that's a little confusing. Is you can have the business pay the premiums, you can have it billed to the business pays it, but they would have to then consider it income to whoever is the owner. So the payor doesn't have to be the owner. So that's another thing that sort of screws up. But the other way to get around it is you can create a split dollar agreement. I'm not going to do my 2.5-hour split dollar class again, but if you have any clients that have split dollars and either A, got rid of them but didn't clean up the policy, or B, had one of these situations and thought they wanted to have a split dollar, how do we get to hear from there? Just give me a call. So that was my little bit on Three Coins in the Fountain on the Unholy Trinity. I'm going to give this back to Mark, and we'll get probably a little bit more modern songs coming up.
Thank you, Keith. Well, actually, the next song is One is the Loneliest Number, and so I'm not exactly sure how modern that is, but it's definitely more modern than Three Coins in the Fountain. What are we going to talk about next? A second-to-die policy with one deceased. As the policy states, this is a survivorship, whole life policy, universal life policy, what have you, and so the death benefit isn't payable until